Hi, this is Mac with PriceActionTradingSystem.com, and this is Thursday, March 29th, and this will be our chart lesson for the day. And we pretty much had a similar day to yesterday. We had this spike down, and then we went into a channel. And let me describe this real quick before I talk about the trades. And then we had a break of the trend line, a couple of legs down to a new low, and then we reversed into pretty strong trend to the upside for the rest of the day. Most of that was in the late afternoon, but this is a pretty good move. So maybe the down sell is off, is reversing now. This could just end up being a range day from the highs to the lows, but maybe we'll reverse out of this sell-off and start to climb higher again. But we're still testing both sides of this 1400 area that you've heard me talk about several times, and so shouldn't be anything unexpected, because that's kind of what happens around these century marks. So but let me just tell you about this pattern right here. This is what I call a spike in channel. Notice how prices spiked down and they went into a channel, and you'll see that a lot, and you'll see prices do just the opposite, spike up. And this is kind of a spike in channel to the upside. Prices spiked up and then went into this little channel, and we had the break of the trend line here, and then let me just show you that. I'll put that on there just to make it easier to see. There's your trend line, there's your break, and then there's your two legs up to a new high, and then what happened? Prices sold off. So that's a typically what we expect of our trend lines. And again, what happened here was prices spiked up and went into this smaller channel, and this is not a great example, but it's an example. And if you copy that and paste it and you move it over here, you kind of see you had this little channel right here, but it was really more of a kind of a wedge pattern, to be honest. But that's the way a spiking channel does. Prices will spike and then they'll go into a channel like this until you get your reversal, and that's pretty much what happened. And so just wanted to show you that so you can learn to spot it. Let me just see if I see another one, and that's really what happened here yesterday. Prices spiked down and then we went into this channel. This is not as good an example, but it's the same thing. And here's a real good one. Prices spiked down and then went into this channel right here, and you can probably see this. It was really more probably like that right there, and if you copy that and drag it down, you can see there's your channel. And what happened was, so today is almost a perfect example of what the 27th was in a day's, so that was Tuesday or Wednesday, something like that. And that's really still kind of the same channel. You see how that continued to hold prices across here, and then when it gets outside of it's mostly during the overnight hours. So it did kind of continue to hold into the next day, and it even came back into play a little bit today. So, but hopefully you understand that. I just wanted to make that type pattern clear to you, because normally you're going to get your trend lines up here off these first couple of swings, but that's just so steep that this was really your trend for the day right here until we had the break and then a couple of legs down to a new low. And then look what happened. Prices, they struggled to go higher first, but once they got their footing, off to the races we go for a trend to the upside. So let's talk about the trades real quick. There was actually a short right here. It wasn't a great short, but it's still a two-legged pullback with a small doji up here just above all these overlapping bars. So if you went short right there below that, let me make this a little bigger. Maybe it'll be easier to see. But if you went short right there, that was a good trade. It was good for a scalp. It was a little risky because we'd already sold off pretty hard and we had all these overlapping bars. But if you saw that and took it, I mean, it's very rare that a two-legged pullback to the EMA does not reach a scalper's profit if it's with the trend, and that's definitely with the trend. But the better setup was this trap right here. We broke below the trend channel. It's kind of an overshoot, and then we tried to go lower again, and we had all these overlapping bars that were bouncing along, that kind of bounced off of this trend channel line, and then we broke lower by a tick or two and trapped everybody, then turned and closed almost on the high. So even though that's a doji, that's kind of bullish right there, because prices, when it went quite a bit lower and created a double bottom and then closed almost on the top. So that's almost a reversal type bar. And again, we did have a lot of overlap, but we're down here at these lows, so we're expecting a bounce and probably a rally back up to test the resistance area. And look at there, we tested it to the tick right there perfectly. And notice these two legs. You got leg one right there. Then you got actually two legs down, and then there's leg two right there, back up to the top of the channel. So this was a great place to go short right here. And on this trade, if you took it, it was counter trend, but it was right at the 8:30 open, and we were kind of in a range here. So if you took that one because of that trap right there and the two legs down, expecting another leg up to come back and test this area, then that was okay. But this was the better setup, and you can see how prices quickly dropped lower. And then same thing right here, we came off the low side, and a lot of times when it's really channeling like this, you could have gone long right here as well, because there's another failed break lower that reversed with the expectation that prices are probably going to come back. But you know, when the prices are in a trend, I don't recommend counter trend trading. And by this time it was obvious we were still going in a downtrend, so I didn't mark that for that reason. But there's your new low, so you're coming back. There's your first attempt to go lower. You went higher, and there's your second entry short right there with a nice bearish reversal bar. And again, it was an easy trade. And then there was another one right here. I didn't mark this one, but this is still a two-legged pullback to the EMA. But we didn't get back to the trend line, so it's not really as strong. But anytime you get a two-legged pullback to the EMA with the trend, it's generally worth taking. And this one would have been as well. And let me show you, just in case you can't see the two legs. There's your first move up to right here, and then we pulled back, and then there's your next leg up. So going short right there would have been a second. You can't see that it's the first entry on this, but if you went to a smaller chart, which I don't recommend watching more than one chart, so you got to learn to see this stuff on your trading chart. So one of my students got confused with that, thinking that they were supposed to be looking at smaller and larger charts. No, that I don't recommend that at all. I'm against that, to be honest with you. I believe you can see everything on one chart. You just have to learn how to do it. And so learn to spot what a second entry, you know, what these legs would look like. You know, if you have to open a second chart while you're studying your chart in the evening or whatever, that's okay, but don't do it while you're trading. But there's your first leg up, your pullback, and then your second leg up. So there's your second entry short. And if you went to a smaller time chart, you would clearly see two legs up right there. And so going short right there was a good one. And I didn't mark that one because it wasn't a key. Actually, it is a key entry point, I guess, because it is a two-legged pullback back to the EMA and a trending market. So I really should have marked that one. I guess I should take that back and say that I should have marked that one. But I really was expecting prices to come back here, so I didn't like this trade and didn't take it myself. So that's why I didn't mark it. But looking back on it, I should have trusted that EMA and taken that trade, but I didn't. So, but anyway, hopefully you saw that and at least was ready to expect it. And then your next entry was here. We had this pull back to the EMA, but notice how bullish that is. There's not any, even if you look at a smaller chart, it doesn't look like there's probably any other legs or anything in there. So that's your first leg up, your pullback, and that's a good excuse for not to go short right there. Wait on that next leg. The next leg may only make a double top and then turn down, but at least wait on it. But if you measure this leg, there it is, and then there's your pullback, and then look what happens if you drag that up there. There's you almost a perfect measured leg. And if you actually measure it from the closes and so forth, it is a perfect measured leg. So the better place to go short was up here. And again, going short right here, you didn't want to go short below that bar because it's too bullish, and we don't have a measured leg yet. So, and then by the time this one finished, it's kind of a doji, and then when this one finished, it was certainly a doji. So you might could have gone short below that leg if prices would have triggered, but it didn't. And that's why I tell you to wait for the bars to complete. Don't try to sneak in there early. And because if you do, you'll probably get trapped, and then prices went higher and probably would have stopped you out, then turned and went right where you were expecting them to go the first time. That's the way the market works. But let me show you this trade. It would have been okay to go short below this bar, but prices still hesitated, and they tried to come back again. And so if you didn't go short below this one, I definitely wouldn't have gone short below that one or that one, because then you got three overlapping bars. So you want to wait and see what happens, and you see prices tried to go higher again and then came down. So if you waited to go short right here, that was a better entry. But again, you can see prices hung around. So the key was, regardless of where you entered, you had to enter, put your stop above the signal bar, which would have been this bar, or maybe that bar, or even that bar. And again, you got your double top and your resistance line coming along here, and if you drag it over, you see you had it from way over here too. So that gives you some more safety to have your stop by. You know, try to put your stop in those places where they're safe, where you've got strong support or resistance at your back, because if you put it above this bar, you see there's still room for noise just to stop you out, and that's all that was a long trap right there. It took it a minute to get going, but then prices were off to the races, back down to this low. And just look at these. I never measured these today, but there's a leg, there's another leg, and then there's a third leg. So it's really kind of a three-legged move, but I bet you if you measure these two, they're pretty close. There's leg one, then a two-legged correction, and then leg two, and there you go. So sometimes the way you got to look at this was really just kind of a trading range in this area. So the moves down didn't start really till right here, and then you got your two measured legs down, and we made a new low. We closed on a new low down here that's lower than this low. So, and we never could get back below this trend line, so it's holding all the way down. So that's a good clue that we're probably going to go higher. But when you had this failed second entry short here that bounced off this same low, that was a great place to go long, expecting prices to probably come back up and test this high. And what do you know? That's exactly where they went. And you could have gone short right here as well, because this is a two-legged move. But we've had our reverse, we had our break of our trend line and our reversal pattern, so you would almost be counter trend trading. But it was a range, and it was a double top, and we did have this is not a real good reversal bar, and these are both dojis, and this was a doji too. So by the time it triggered, you had a lot of overlapping bars, so I didn't like it for that reason. Now, one thing you might have done is when you had this bar finished and then prices went higher first and then came down, you could have had your stop right there, and that would have got you in it, and you would have been fine and gotten out of it. But I didn't mark that trade because it's just we've already had our reversal set up and all that. So I was starting to think, hey, we're going higher from here. And you see, again, two legs back, and then prices broke higher. So going long here on the second entry long was a good trade. And this is also a double bottom. I don't have I try to keep a lot of this stuff off so my charts stay clean. But look, this is a double bottom that's really just testing this breakout area twice, and it failed. So then we're going higher. And you could have gone long right here, but it was a little risky. It was better to wait for something more bullish. And once you saw that, then it was, again, then we had a really nice trend to the upside there. And so if you caught that one, I don't think your runners would have survived on that one. But if you caught it, and if you gave it enough room, you really made some money here on your runners. And that's why I sometimes moving your runners to exactly break even or break even plus one. You'll get stopped out a lot, but better to get stopped out than to be wrong and give your profits back. So generally what I'll do is I'd just re-enter. What I would have done if I was long here and then we came back and got stopped out, when this broke lower and hit my break even stop, I would have been stopped out. But when it suddenly closed or reversed and went higher again and closed on its very high, I would have been looking to go long again up here, because that's a breakout pullback long, and then look what happened. Your runners would have survived, and you would have caught that all the way up. So I would rather, there's different ways you can do this, and my way is not necessarily the right or the wrong way, but I'm going to explain this real quick, and then I'm going to wrap today up. But my philosophy is I would rather get my profit and get out and look for a new entry than I would to take the chance of making some money and then giving it all back by staying, overstaying my welcome, especially when prices are choppy like this. Because when they are choppy like this, there's a good chance that you can get your scalp and maybe even a little more just before prices come back and test some area or overlap again, and then you get stopped out. And if it is a reversal, if this does turn out to be a double top here that holds permanently, then next thing you know, prices are down here testing this, and you're not only did you have a point of profit from your scalp that you gave back, you may be looking at losing a point or two, and if the downtrend continues, then you're losing 3 or 4 points maybe. So I would prefer to take my profit and just re-enter right here again. And you can see how well that would have worked. I would have got stopped out, but I didn't risk giving my money back. And then I just jump back in right here, and then it's off to the races again, and I've got another scalp. And if prices don't come back and take out that break-even stop, then I'm going to get some more, and you would have got a good bit of this. I was done trading by this time, so I didn't trade this, but that's how I would have traded it were I was still trading this market. So hopefully that makes sense to you. And again, that's not necessarily right or wrong. That's just the way I do it. And a lot of people ask me, I get asked consistently, and I know you read this all over the place, that you can't scalp for a tick and trade with a 2-point stop. I'm sorry, you can't scalp for a single point, 4 ticks, and then use double that for a stop and make money. It's impossible. Well, if you're not very good at reading the price action, that is a correct statement, and that's exactly right. But if you learn how to read this stuff and you get good at entering at the right places, the odds are on your side that prices are going to move 4 ticks in your favor before they move 8 ticks against you. Now, if you're entering long up here, you're going to get stopped out every time, and you're right. You can't make money scalping out a single point and then being wrong on the next trade because you give everything back that you made plus some more that you didn't make. So the statement is true, but you have to learn to trust the strategy, because we've back tested it. We've ran tests on it, and you can actually flip a coin, and regardless of the direction, just flip a coin, and 50% of the time prices will reach 4 ticks one way before they'll go 8 ticks the other way. So knowing that you got a 50-50 odds of just guessing and getting it right, if you are entering in the right direction and your timing is good, you're going to greatly increase your odds. And that's how we get to the 60 and 70, and then the better you get at the price action, you can get up there and even do 80 and 90% wins. Sometimes patterns fail just simply because even when they look great. I mean, I've seen trades like this, 2 legs back to the trend line, that just simply fail. And that's just the way the market is. Nothing's written in stone, and generally the direction will still be right, just like right here. Prices just went a little higher than normal, and that's because the trend, the buyers are starting to get stronger and the sellers are starting to get weaker, and that's what you're looking for. If the buyers are stronger than the sellers, then prices are probably making higher highs and higher lows like this, and we want to be looking for longs. And if prices are making lower highs and lower lows, then the sellers are stronger than the buyers, and so we're looking for shorts. And again, the key entry points are support and resistance. Resistance there, resistance there, resistance up here. We're looking to sell at resistance and we're looking to buy at support. And remember, this is what's key. This line right here is resistance. It's just an angled resistance level. And this area right here is support. It's just an angled support area. And you always hear me talking about how a lot of times once prices get above resistance, then that resistance becomes support. And once prices get below support, it then becomes resistance if prices are going to continue with the trend. And here's a good example. Here was the downtrend, prices broke it, but then what was resistance, look how it's acting as support now. Every time it touches it, prices touch it, it bounces. So there's no difference between this resistance area and this resistance area. They're both strong resistance. So just keep that in mind and make sure you understand that. But we're at 20 minutes, so I'm going to wrap it up. This is Mac with PriceActionTradingSystem.com, and we'll see you next time.